those who don't know me, my name is Moritz Schild. I'm one of the founders and board members of Hanseatic Blockchain Institute, and we are an association in Hamburg, Germany, that aims to, first of all, help people that are in the crypto and blockchain space to exchange ideas and to communicate and to network. And then secondly, we want to help educating by helping understand concepts and ideas that come up in the blockchain space. And in order to do that, we have since our very beginning had more or less a weekly event called Blomo Blockchain Monday, which used to be a physical event here in Hamburg. And we switched to this online format due to COVID. We look forward to having some events physically quite soon, and we will communicate that later on with the dates and so on. I haven't prepared for that, to be frank. Nonetheless, Blomo intends to just help looking at blockchain and crypto from different angles and perspectives. We sometimes have lawyers talking about blockchain and data protection. We have tax advisors that tell us how to ensure that our crypto profits are properly taxed. We look into quite technical details. We always have had different startups presenting their projects and ideas, and of course we monitor closely what's happening in the Bitcoin and Ether space, because for the time being these are the most relevant blockchain applications and use cases. Just a brief remark for those who don't know us. Hanseatic Blockchain Institute is an association in Germany. We are a Verein, and everybody who's interested to support our work can become a member just by going to our website, which is Blockchain Institute with an E in the end, .eu, and then you can easily apply to become a member, which I would appreciate, of course. Having said that, I would like to move to our subject for today and our speaker. We want to talk about Ethereum. We want to talk about DeFi a little bit, because Paul is founder of a company called Alloy, and Alloy intends to build a platform helping institutional investors getting exposure to DeFi, which is bridging two worlds somehow, which is quite an interesting project, and Paul might tell us a little bit more about it later on. Nonetheless, the core we want to discuss and talk about today is the number one event in the crypto space is this year, the switch of Ethereum from proof of work to proof of stake, which many people have been talking about and have been discussing about. And from my initial discussions with Paul, I strongly believe that he's quite deep into it and has a good understanding what it means, what the outcome is, and what the implications might be. And with that, I would like to hand over to you, Paul, and maybe you give us a short introduction to when did you do it the first time? So when did you cross the crypto space, and what made you initially look into it? And if we were at a physical event, there would be a huge applause now for you entering the stage. Please imagine that. Anybody who has questions, please use the Q&A function provided, so we can do it as interactive as possible. Paul, the stage is yours. Great that you are here today.
Thank you so much, Moritz. Much appreciated. So I'm Paul. Very nice to meet all of you. I'm the co-founder of Alloy, which is a company that is building a product in the fintech DeFi space. Actually, I initially got into crypto in 2015-ish. I was really into poker back then, and kind of made from playing poker or DeFi, all of that. Basically been there from the beginning of DeFi, from it not existing to it now being quite a large thing, and was very active throughout that whole journey from 2015 to today, on chain myself, and then met Adrian, my co-founder, and Tim in uni, because we were kind of working on similar things there. And basically, we never really planned to start a company around that, but we were kind of managing our own things on chain and noticed that there isn't really good tooling to do that in a sophisticated way, where we would build our own portfolio management tooling and where's my collateral, where do I have exposure, what protocols am I deployed into, and we didn't really see a good product for that, and so we decided to build it. So yeah, that's me. Let me actually share my screen because I brought a presentation for today, of course. I think, Moritz, you have to allow me to share my screen because it tells me. No, I can.
I think yeah.
So preview. So, oh no, wait, I have to allow Zoom to allow it to look at my screen. I'm gonna have to quit and then rejoin Zoom to share my screen. I'm super sorry. I'm gonna be back in 1 second.
Hello. Okay, and now the difficult thing is that he is not using the moderator link that is showing up. Where is he? As a participant, and I have to upgrade him in order. Paul, wo bist du? Da, Paul, Sekunde. Und jetzt wird er zum Diskussionsteilnehmer befördert. Pling. Und erscheint. Toll. Jetzt bist du noch auf Stumm?
Apologies about that. No. Finally. All right.
Okay.
Preview. Share. All right. Now you should be able to see me.
Yep, perfect.
Amazing. Okay. So the topic we're discussing today is Ethereum's transition from proof of work to stake, which is also called the merge. The reason it's called the merge is because it's basically two chains merging, but I'm going to get into the more technical details of all of that later on. The basic outline we're going to be talking about today is, first of all, what is the merge even? Then looking at how consensus is reached on Ethereum right now, which is proof of work, and then comparing that to proof of stake, especially looking at the energy usage aspects of that, which are very, very different. Then the supply dynamics, because first and foremost, the merge is really a change in monetary policy for ETH, which is very interesting. Then we're going to have an in-depth look at how staking yield is going to develop post-merge, and kind of a few of the variables that are relevant there, which is quite interesting in my opinion. And then why is it an interesting opportunity, especially for institutional investors that are looking for not the super speculative side of the crypto investment world, but really kind of the long term and betting on like a true decentralized future and doing that in a sensible way. And yeah, I think Ethereum is probably a good starting point for that. And so yeah, I think really kind of the DeFi staking Ethereum ecosystem is very interesting to especially the more sophisticated investor crowd for that reason. So what is the merge even? Basically, it's a term that is used to describe Ethereum's transition from proof of work to proof of stake, which are two distinct consensus mechanisms. So basically, a consensus mechanism is really a mechanism of how a blockchain tells what truth is, which is necessary to avoid double spending and avoid fraudulent transactions. And so basically the core challenge that a blockchain solves is distributed truth. And so one way of doing that is proof of work. How that works, we are going to get into in detail. And another one is proof of stake, which Ethereum is moving to. interesting side note to that is that this has really been years in the planning. The first time Vitalik Buterin, who is the founder of Ethereum, mentioned that he thinks Ethereum should move to proof of stake was actually back in 2013, which is basically decades ago in crypto time, where kind of one year tends to be quite tends to lead to quite rapid change. And so it's always interesting to see how these like very long-term visions play out. This is a more detailed roadmap. I don't know how much of that you can see. This is from the Ethereum Foundation. So basically there's the merge, which is step one, which is likely to happen in mid-September. And then there's the surge, the verge, the purge, and the splurge. It sounds like a joke, but those are the actual names of all of these upgrades. Interestingly, actually, so Vitalik Paris at the Ethereum community conference, and he said that Ethereum is currently about 40% finished, and then after the merge, it's around 55%. And so like it's probably not relevant for today, or I'd be happy to talk about it, but all of these and getting into sharding and really separating computation and consensus and basically building an ecosystem of L2s where you have sharded computation, and all of that is kind of further out in the roadmap. And so there's still some very interesting things coming even post-merge. So what does the merge do? I think the two most really are, number one, it's a significant change in supply, where really between 12 and 13,000 ETH is issued to miners every single day. And a large portion of that is just market sold, especially in environments where ETH price is lower, but difficulty doesn't get adjusted down quickly enough. And so miners run on pretty slim margins and just have to sell everything that they get as rewards back to cash. And so you have significant supply overhead that just kind of comes into the market every single day selling ETH. And that goes away basically. And we're going to get into the supply dynamics more in detail. But there's a very good chance the total supply of ETH is actually going to be deflationary instead of inflationary. Right now, the ETH supply inflates by between 4 and 5% a year, and post-merge, and we'll get into how all of that works. It's likely to be below zero, which is a drastic change, obviously. And then there's drastic improvements in energy efficiency, where really proof of work is extremely wasteful, and because it's basically really forcing large data centers to expand mining, which is basically solving very complex riddles to secure a chain. And miners obviously have to bring all of this infrastructure and really it's just an inefficient way to secure a blockchain, which has been known for a pretty long time, but so far there hasn't really been a good alternative. And now there finally is, and it has really kind of been quite the journey to get here. But yeah.
Just briefly coming back to Vitalik's initial idea in 2013. So what was his kind of driver? What was the reasoning behind him saying we should switch from proof of work to proof of stake? Was it energy, or was it just the scalability, or just avoiding the miners, or what was the driving force?
So I think it's two things mainly. It's really, so number one, it's about efficiency, where proof of work is just wasteful, but so far it has been necessary. And then it's decentralization, because I think really the centralizing force of having proof of work is quite large, where now it's impossible to be an individual miner. Like it's uneconomical. It makes no sense. Like you in Germany as a regular person that doesn't have 50 million euros to spend on kind of building a data center somewhere where energy is cheap, you lose money on running a mining operation. And that leads to the network being quite centralized to a few large mining pools, because you need those economies of scale to mine profitably. It just isn't possible to mine on like a small scale. And that pushes a lot of the kind of smaller individual users out of the system and leads to there being a few very large kind of mining companies that basically control the entire consensus mechanism.
Okay.
Yeah. So what does the merge not do? It doesn't immediately do anything in terms of scaling. So transaction throughput is not going to be improved. There's a very slight ramp up in the block production rate speed, which goes from an average of 13 to 12 seconds. But that's very likely not noticeable for most users. And so it really doesn't do anything for scaling. And then also withdrawals aren't enabled yet when the merge comes. So right now there's a beacon chain where you can stake your Ethereum and you cannot withdraw it. And then there's going to be a separate hard fork, which is the Shanghai hard fork, which is then going to enable unstaking of that staked ETH. And that's likely to happen in 6 to 12 months from now. And then there's going to be a queue to unstake. So really, like the supply that is staked right now is likely to be locked for a pretty long time, really.
Why is that? So that's technically driven, or is it something that the community has decided to do in order to make the transfer to the staking consensus mechanisms easier or less disruptive, or what's the reasoning behind that?
It's mostly for security / incentive to keep the network safe reasons, where the reason the queue was introduced to unstake is so not everyone can unstake at once, and then kind of one entity controls a majority of the staked assets. And so really it's in the network's best interest to have as many people stake and kind of have the base of the stakers be as broad as possible. And reason to then kind of slow down on staking is so you have that large base kind of guaranteed, and like not a single person kind of threatens everyone else to unstake and then controls the entire network, for example.
Okay.
So let's look at the differences between proof of work and proof of stake a bit more in depth. So like I said, proof of work is a consensus mechanism that uses computational power to mediate block production and ensure security. Basically, you have a really, really large competition between mostly data centers, really. Like there is no individual miners, at least not profitable ones. And they all race to solve a very complex riddle. And when they are the first to solve that riddle, they get awarded a block and get the associated ETH issuance plus the transaction fees. And proof of work incurs extremely high overhead because you have to build a data center and you have to buy machines and you have to pay for electricity. And so the kind of assuming that everyone who's a miner is acting rationally, which I think is a sensible assumption, you have to compensate them for all of this overhead and all of this investment they have to put in order to be able to mine. And that makes the entire system quite inefficient, where you have an incentive system where people have to invest a lot of money up front to be able to participate, who then expect to get that investment back, obviously, otherwise they wouldn't do it. And so you have to design the system in a way where the people get compensated for having to put in a lot of initial capital. And that is just very inefficient. So proof of stake, to the contrary, is a consensus mechanism that is mediated by validators that have staked ETH to participate in the system, where it's the easiest way to think about it is like a security deposit, where you deposit a number of ETH which in the case of like the system, it's how it's designed right now is 32 ETH. So one validator is 32 ETH. You can only stake in increments of 32 ETH. And you put in that deposit to the network, and then you validate blocks. And then if you do something that is fraudulent, or you basically do something that contradicts the truth of the other validators, then your ETH gets slashed, which is kind of a complicated term to say that your ETH gets taken away from you or kind of reduced, where it's really kind of, it's uneconomical for you to act against the best interest of the system, because you have money invested into it, and then kind of acting against it, the money you have gets taken away. But of course, you want to get compensated for the opportunity cost of your capital, because capital is not free. And so the network pays you a staking yield for you kind of putting the security deposit in. Yeah, this is just a more kind of comprehensive comparison table between proof of work versus proof of stake, which is basically most of what I said already, where you have different security aspects of that. Arguably, proof of stake is a lot more secure, and it's definitely a lot more efficient. So now let's talk about the energy consumption, which is drastically reduced. So proof of stake, the chain on proof of stake is going to consume 99.95% less energy. So it's actually going to consume 1/26th of how much PayPal is using yearly, which is an interesting comparison in my opinion. And yeah, kind of compared to where ETH proof of work was, where so much energy was just kind of poured into computation that was ultimately like wasteful isn't the right term, but inefficient, I would say. And
okay. So, is there a source to this slide? Because this is...
It's from the Ethereum Foundation.
Okay.
Yeah, we just took the data from them. So yeah, drastic reduction in energy consumption, making it a much greener asset that burns basically negligible energy. And I think that's a drastic change compared to where proof of work ETH is right now. So let's talk about the supply dynamics. I already kind of mentioned that a bit, where 80% of the miner issuance is just market sold, which is 10.8 thousand Ethereum, which at current prices is $18 million a day, which doesn't sound like a lot for a multi-billion, like multi-billion dollar market cap coin. But kind of thinking about how much volume that goes through daily is truly discretionary, and has has a tendency to move markets. It's actually quite significant, and kind of taking that overhead away. It's basically today ETH has to have $18 million a day in inflows to maintain price. And so basically, if nothing changes and like no inflows, no outflows, but there's minus, the price of ETH goes down for obvious reasons, because you have sell pressure, but like no additional inflow. And that's going to change, where it's likely to be deflationary, actually, where kind of supply gets taken off the market, and so you actually need slight outflows to keep the same price. And kind of if in and outflows stay the same, then price goes up, ceteris paribus. So yeah, comparing that to the Bitcoin halvings is probably the closest we've ever seen as a parallel in the crypto markets, where really the block rewards are reduced. Interestingly, actually, I mean, I would argue that the merge is a massive improvement in both fundamentals and the security of the protocol, whereas the reduction in block rewards in BTC actually makes the network less secure, because it incentivizes miners less strongly to participate. And so the closest parallel there is really the BTC halvings, but it's 3 times as large on a percentual basis. And so it's a very significant event from a supply dynamics standpoint.
So with the merge taking place, it means that there are no rewards required anymore. E.g., there is no additional Ether being generated after the merge. Is that correct?
Not completely. There is Ether generated, but there's also, so after EIP 1559, a portion of the base fee is burned, the base fee of every transaction. Yeah. And so you have a mechanism where new Ether is being issued, but more Ether is being burned through just users paying for transactions. So it's not that like you have experience, but larger offsetting burn.
But who gets new Ether if there are no miners?
The stakers.
Sorry?
The validators, meaning the people who stake.
Oh, okay, they get staking rewards from the system. Yeah.
Exactly.
From the network. Yeah.
The second yield, and I'm going to get into this in detail now, is basically made up of 3 components. One is the kind of staking yield that the network is paying, which is fixed, and that's why it's relevant that is relevant how many other ETH next to yours are staked. The larger the pool of staked ETH is, the smaller the rewards the network kind of pays to one individual staker. Then there's transaction fees, which are just usage of the network. And then another question mark is around MEV, which used to be miner extractable value, but now it's maximal extractable value. I'm going to get into that in detail as well, and how much that is and kind of how much that adds to the yield. That one is a bit more complicated to forecast, really, because it doesn't have a parallel right now. So you kind of have to guess a bit about what the variables are going to be.
Okay. So there's a question from the auditorium asking, does it mean for validators it's not that profitable as it used to be for miners?
I mean, so I think that's a tough to answer question, because like it's tough to know how profitable miners in aggregate are. No, I mean, I think kind of depending on what you think the aggregate margin miners were making, it's probably somewhere between 5 and 10%. So I would say staking is probably in line with that, but it's a less resource intensive activity where you don't have to invest tens of millions of dollars to even compete. And so it's kind of tough to compare that, I would say.
Okay.
Yeah. So we built this model. It should say source into the block for the data, but it doesn't. But just gonna have to take my word for it. And we basically looked at a few different scenarios about how the variables I've spoken about could play out. The 2 large variables that we kind of did an analysis on is how much ETH is staked, and then what are the fees, the network fees that are going to stakers. And yeah, this is our kind of basic analysis of what these variables might look like. And assuming that no new ETH gets staked between now and the merge, and daily fees are at the exact same level they've been for the last 30 days, which is down 90% or something, you would get a yield of around 9.9% after adjusting for the MEV side of things, which I'm also going to get into in detail. And then you can kind of play around with the numbers, and so the transaction fees are down significantly because they have pretty high beta to price, really. And activity has slowed down on ETH a bunch. A large component is probably also that contracts are getting more efficient. I mean, for example, OpenSea just switched the contract they used.
I think the connection was a little bit bad. And maybe could you repeat why the gas fees are likely to go down?
No, so I don't think gas fees are likely to go down. I think gas fees are like the total gas fees spent on the network in aggregate. They are down, but that doesn't mean that like it does mean that individual fees are cheaper as well, because they are a function of how many other people are competing to be in the same block. But actually, I think the opposite. I think that kind of as usage comes back, and that has always been very cyclical, where you kind of have these adoption cycles. And it's down 80-90% depending on when you measure from. Like it used to be a regular day that 10,000 Ethereum are spent on gas fees a day. Now it's between 1,000 and 2,000, so it's quite volatile, and that's a large component of estimating what the yield is going to be. Because the way it works is you have a base fee, and then you have kind of the excess transaction fees, which is a tip. And the tip goes to validators. And so the larger kind of the usage of the protocol, the larger your staking yield is also, because fees are going to the validators. So yeah, let's get back to the kind of model of how we model what yield is likely to be. So this one was looking at the sensitivity to the fees and sensitivity to how that might change. Just modeled it as like looking back 30 days, 90 days, and 180 days. The average fees the last 180 days are significantly higher, because just activity was a lot higher. And so I think there's a decent chance that kind of mean reverts to the upside. But even if it doesn't, it's still very attractive. And then we also looked at how many ETH are staked. So right now, there's about 13.4 million ETH staked on the Beacon chain, and just you assume that there's going to be 20 million ETH staked, which is an increase of 1/3, and then the yield goes down, because kind of the pie you are sharing stays the same size, but the people eating from the pie just get more. And so that impacts yield, obviously. We talked about the transaction fee. Let's talk about the maximal extractable value side of the coin. So there's a concept that is called minor extractable value, which is basically anything that so you can pay to be included in a block, but then there's also kind of the next level of that, where people are doing arbitrage and want to make sure that their transaction is at the top of the block, because they get executed in that order. Or you can exclude transaction, or you can basically there's a whole kind of cohort of things you can do in MEV, where you change the makeup of an individual block, and that is very expensive to do. And right now, that is revenue that goes straight to miners. Flashbots estimates that it's 0.18 ETH per block, and as long as mining is no longer a thing, that will go to validators, where the validator of a block can then basically accept bribes from users to change the makeup of the block, and that's also going to add to the staking yield.
All this sounds a little bit like illegal activities. So from your point of view, is the merge going to make ETH a more decentralized, democratic, fair, transparent process, or are there some
I believe so. I mean, I think it lowers the entry barrier significantly to participate in the consensus mechanism. And then, like, really, MEV isn't a new thing. Like, it's been around since 2017, 18 on ETH, with people front running each other on DEX trades, and people doing kind of atomic arbitrage, where you buy and sell in the same block, and sandwich someone where they get a worse price on a DEX trade, and all that has been going on for a pretty long time. there's ways to kind of not be affected. And I think there's definitely a large kind of, it's a separate discussion really about kind of the morality of MEV and the morality of front running and doing arbitrage. But I mean, that happens in normal financial markets as well, right? And so, yeah, I don't think that's not really a new thing. And it also doesn't really have anything to do with the merge. It just kind of changes where the gas fees are spent, which now is no longer the mining side of things, but the validators. So yeah, to sum up the staking yield section, we estimate real staking yields between 8 and 11%. Real because there's a lot of crypto assets that have staking programs and that give out staking yield, but most of that is paid for by dilution, which doesn't really have you're just treading water when you own 1% of the network and it inflates 10% every year and you get a 10% staking yield. You still own the same percentage of the workout of the network, and so you might have a larger number of coins, but it doesn't really move the needle on your ownership of the network. And so I think a lot of these staking numbers that other crypto assets have are quite deceptive, where it's really kind of, it's not real yield, but it's just dilution that is impacting the people that stake less. But that isn't really yield in my opinion.
Okay. And so what does a yield mean for the price, or do you come to the price later?
Well, I mean, I'm in no position to make forecasts about the price of any asset, because this is not financial advice and just for information purposes only. And so, I mean, I think Ethereum is probably the best risk-adjusted bet across every single asset class. But that is my personal view, and I would never tell anyone else.
No financial advice, no financial. Okay, yeah, got it.
Don't get me on this. I'm also incentivized to believe that, and so yeah, take that with a grain of salt. And I think really where it gets interesting is when you combine staking and DeFi. I think you can, as you kind of get into the more sophisticated and more advanced side of DeFi, where you can not just stake your Ethereum, but then, for example, in the case of if you use Lido, which is a liquid staking protocol, you can stake your Ethereum with Lido, but then you can also take the staking derivative, which is a staked ETH in the case of Lido, and provide liquidity on Curve with it, and drastically improve your returns. If you want and you have the risk profile for it, you can take out leverage on your staking yield and use Aave to lever up your staked positions. You can basically, you have probably 6 or 7 protocols on Ethereum layer 1 that I would feel comfortable using, and combining all of them to improve your staking yields is a very, very interesting opportunity, I think, especially if you have a more long-term view and you really kind of want to hold the asset for many years, and it matters whether you make 8 or 12 or 15%, and that really moves the needle. Then I think it makes sense to also look into how can I kind of combine my staking activities with kind of other DeFi protocols, and what's kind of the best way to optimize that. And yeah, it's interesting because it's so hard to really do staking as an institution right now, at least to do it well. The options are quite limited. The largest centralized staking provider is Coinbase Prime by far. I think they make up 13-14% of the entire supply that is staked, and they charge around 25% in staking rewards, and just kind of, so if you would make 5%, you only make 4%, and the flexibility you have is really quite low, where your option is to have your ETH sitting there or have it staked, and like nothing more advanced. And the market agrees. Lido has almost twice as much in ETH deposits as Coinbase does, And so people kind of overwhelmingly choose to use decentralized infrastructure to stake their Ethereum as opposed to the large centralized exchanges that don't use the protocol layer infrastructure, which is a shame. And is
can you, sorry, just coming back to the pie chart. So the red one is Lido or Binance? That's
Lido. So the largest one, 30.9, that's Lido. This is individual stakers, so kind of like uncategorized. This is Coinbase. This is Kraken, the 8.4%.
Okay, and the legend on the right hand side is just in alphabetical order, and so it's exactly. A bit difficult to.
Exactly. That's a bit confusing. Yeah, no, but it's Binance, Kraken, Coinbase, uncategorized, and then Lido, and Lido is by far the largest. So yeah, to summarize all of that, Ethereum is going through its largest upgrade ever, moving to proof of stake from proof of work, which is the largest and most significant development it's ever gone through, and that will make it incredibly more energy efficient and will also improve security economically, where you have people incentivized to secure the system. And investors can participate by staking the Ethereum to participate in the consensus mechanism of the network, and get a yield of between 8.5 and 11%, depending on how a few of the variables actually work out in the real world. And that's actual real yield and not paid for by dilution, but it's paid for by Ethereum is one of the few blockchains that has real usage with real users paying fees to be included in blocks. And that revenue just gets passed on to validators, which is stakers. And I think that's a very, very interesting thing to think about. And the best way to do that is to look at a product like Alloy. Surprise, surprise. Because what Alloy basically does is to give sophisticated institutional investors access to the entire stack of on-chain protocol layer DeFi infrastructure, where you can use existing DeFi protocols, stake your Ethereum with Lido, then take your staking derivative and provide liquidity on Curve, use Aave, use Compound, use Uniswap, LP on Uniswap, and basically do anything you can do on-chain, but do it in a compliant and regulated and really institutional grade environment. And that's it from my side. That's me. If you have any questions, then feel free to email me.
Cool. Yeah, thank you very much. Everybody who's attending, please feel free to use the Q&A section to ask your questions. And so for me, you mentioned earlier that within the period where the merge is going to take place, the ability to unstake or to take ether out of staking contracts will be limited or reduced. Is that right? And so with that in mind, one might argue that it's better to start staking ETH after the merge has taken place, or what would be your kind of low risk investment advice in this direction be?
That's a good point. I mean, I think it's
now the connection
is likely to take 6 to 12 months, really, where separate hardwired. I think if you have a long, I'm sorry, can you see me? Can you hear me?
I can see you, but the voice connection was a little bit bad. So maybe you just repeat your
back now. So I think that's a very good question. I mean, it's going to take 6 to 12 months to unstake ETH. If you use something like Lido, you kind of get around that, where you get a staking derivative that you can sell back into the market. So you can kind of circumvent the unstaking not being enabled yet, which I think is a large.
This only happens on the Beacon chain itself, and all derivatives are more liquid.
Exactly. No,
Yeah.
so the thing is, like, if you stake through Lido, you get staked ETH, which is the equivalent of having 1 ETH staked, and it's going to be redeemable for 1 ETH as well, but it isn't yet, but it will be as soon as unstaking is enabled. But what you can do is just take the derivative and sell that. And so you kind of get around the, like, you're still liquid, you can go in, you can go out. But even if that wasn't the case, I mean, if you have a long-term view on kind of crypto assets and you want to hold your Ethereum for 2, 3, 4, 5, 10 years anyways, then it doesn't really matter. And it's quite interesting, the amount of so 11.2% of the supply is staked currently. And all of these people who staked are people who don't know when they will unstake, which is basically a really big show of faith into the ecosystem, where you're basically saying, I'm willing to participate in the staking mechanism and in the consensus mechanism without even having a definite timeline when I'm going to be able to get out. And so I think that actually shows kind of the large capital support that ETH has.
Okay. So looking at the process, and I think you mentioned earlier that this is quite complex. What could go wrong, and what would be the outcome, or what is at risk? What is your view on that? And please, everybody, add to our discussions and pose your questions.
Sure. I mean, so that there's obviously a lot of kind of small things that can go wrong, and a few large things. The way these major Ethereum upgrades work is they don't just get pushed into the main chain and then you see if it works or it doesn't. But there's a large number of test nets where that gets tested first, where basically you have parallel versions of Ethereum running, and you can test it without having money and an entire ecosystem of applications at risk. And Ethereum has gone through all of these test nets now, with now so-called shadow forks happening in kind of basically parallels of the Ethereum proof of stake chain. Still, I mean, there's a chance things go wrong. Especially, I think the larger risk really is if you are a user of protocol infrastructure right now, and there's some funky processes around kind of what collateral is still going to be worth something, with now, for example, Circle, which issues USDC, now saying they only honor redemptions on the proof of stake chain. And the way the upgrade is going to happen and feel for users is, you basically, the proof of work chain is still going to exist, but it's going to be a new chain that then kind of forks, and it automatically changes over to the proof of stake chain, but the proof of work chain still exists. And so you then have PoW ETH and proof of stake ETH. And I think that there's some potential for things really going wrong on the protocol layer, where you then have outstanding loans in PoW ETH, which is then close to worthless, or you have kind of then worthless collateral you can loan other assets against, and all of that. So I think especially on the lending side of things might break. But the transition is going to be like, there's no downtime. And so it's going to happen immediately. So there's no like time lag risk, for example, with oracles not updating or something. And I mean, it's really been years in the making. So every single protocol has spent a lot of time thinking about this and knowing it would come. And so I think the risk, the probability of things going really wrong is likely low, in my opinion.
There's another question that leads in this direction. How do you assess slushing correlation risks when using permissioned staking pools like Lido, possibly reaching critical consensus thresholds, for example, 33%?
So, I mean, I think that's a very interesting discussion, really, especially kind of now with mining pools starting to not include transactions that are from addresses that interacted with Tornado Cash, which has been sanctioned. And so I think really kind of the largest battle that Ethereum has to face is to make sure that things like things stay decentralized, and not a single entity can basically decide not to include transactions. I think you have the same issue in proof of work, right? Where, for example, Ethermine, which is the second largest mining pool, doesn't include transactions that involve the Tornado Cash contracts. They don't include those transactions anymore, probably for kind of fear of legal action. And so I think the issues really exist both in proof of work and proof of stake. I think especially the risk, and this is the next question as well, about kind of like how is proof of stake more decentralized and more secure than proof of work? Isn't there considerable centralization happening if everyone stakes through Lido? Yes, I think that's definitely a large risk, and there has actually been some talk like at Lido internally about kind of limiting the percentage of staking they would do on the network. I mean, so withdrawals aren't enabled yet, and so that mechanism isn't really fully fleshed out, but people can say, I leave this pool if they do something I don't believe in. I think that's really a temporary solution, where in 12 months, when you can withdraw your assets, then the barrier to entry to really running your own node and being your own is much lower. And which is probably in large part driven by the ability to be liquid and have a staking derivative. I think the if we go back to the pie chart, I think the gray area of people that aren't in any pools, I think that's going to increase with people just natively staking themselves. And so I think in the short term, that's definitely a risk, but there's a path for that risk to be solved, in my opinion. Okay. And then, sorry, I'm just reading the second.
And the second part of the question is it easier to accumulate Ether compared to accumulating hash rate as the limited supply of mining equipment on the market?
So I think that the game theory of that is very interesting, because it really like buying a large portion of the ETH supply to then attack the chain makes the ETH you bought worth a lot less, which makes it super like economically costly. And so I think really the incentive to buy 51 or 33 or 66% of the supply to then tamper with consensus, that economically doesn't make sense, because then you own a large share of a network that no longer kind of has integrity. And so it's really kind of you hurt yourself economically. And so that type of attack just doesn't really make sense. And then again, like 33% of 200 billion is 70-ish billion-ish. And so that's really a large amount of capital you would have to put in to attack that system. And you're probably losing most of that. And so like the question is there someone out there who's willing to spend $70 billion plus on attacking Ethereum? And maybe there is, maybe there isn't. My bet would be there isn't. And also like the incentives to do that don't really make sense.
Okay. You showed us this diagram of the different steps which you didn't reflect on in more depth. I mean, the entire process, is it very complicated? Is it extremely complicated? Who is orchestrating the entire process? Because this is new. There has never been a merge of a blockchain of a DLT based cryptocurrency to a new consensus mechanism, or apart from the test chains, or is it something that happens frequently and that's standard?
No, it doesn't. I mean, there isn't another example of a prominent blockchain moving from proof of work to proof of stake. There's a few smaller ones that have made that shift, but I would argue that that's a lot less relevant when like smaller networks do that, because like Ethereum is the only one that actually has massive real usage and real users using the system every single day that is now moving to proof of stake. I mean, the merge is only like a small part of the entire roadmap, which really I think the next biggest step is then improving scalability and how basically they're planning to implement sharding, which is where you push the computation of transaction and then the settlement onto kind of different threads and not have them all be on the main chain, which is a very interesting idea. And there's a whole ecosystem of L2s now, so layer 2 solutions to Ethereum developing, which I think is kind of the first step towards having your consensus mechanism and your kind of settlement layer be Ethereum layer 1, but the computation happens somewhere else on an L2. And I think that's really the future of scaling, where it's not necessary for Ethereum layer 1 to handle all of the computation, but it's enough if like Ethereum layer 1 is the security infrastructure where all of the other kind of layer 2 chains that handle computation then settle on. And I think that's really the future of Ethereum, to have an ecosystem of other chains where computation happens, and ETH layer 1 is where settlement happens.
Is there a time horizon to this chart? When would you expect the next steps to take place, or is it something that's...
So I mean, the merge was supposed to happen last year, and so I'm kind of thinking about the timeline. There hasn't been a major upgrade to Ethereum that wasn't somehow delayed for technical reasons. EIP 1559 was 6 months late, and so it's really Ethereum tends to be ambitious with timelines, and then they don't work out. And I think that's the reason why they've kind of stopped giving super specific timelines. I think the surge, which is the next step, is planned for either next year or the year after, but it's really a multi-year roadmap. Like all of that is not going to happen this year or next year, but it's really kind of a 2, 3, 4, 5, 6 year plan for. I mean, so what Vitalik said in his kind of outlook and vision talk is that the ultimate goal is for Ethereum to be able to process 100,000 transactions a second, which is a massive improvement. And so like there's definitely some delta between where the capabilities are right now and where they will be in the future.
All right, let's briefly touch on your Alloy project, which you mentioned a little bit. So I fully agree that making the complex DeFi mechanisms and protocols easier to handle is definitely worth putting some effort into it and helping investors getting into it. However, my assumption would be that currently there are much more kind of private investors looking into this space than real institutional money, because they always are reluctant and scared and so on. Why did you choose to say we want to help institutions to become DeFi active or DeFi enabled?
So I missed the last part of the question because you were cutting out, but I got the broad picture. I mean, I think really the big institutional money is probably a multi-year thing, and until they really kind of get comfortable in the ecosystem and then really engage with crypto and DeFi more specifically, really kind of at scale, kind of seeing the first beginnings of that now, really with, I mean, BlackRock is partnering with Coinbase to offer offer crypto investment products and to let large institutional clients get exposure to crypto assets. And so you're kind of really seeing the beginnings of institutional investors trying to like slowly getting comfortable with crypto and with DeFi. But I don't think that that's like a binary shift that happens from no institutional investor touches crypto, DeFi, all of that, to all of them have it as kind of a main component in their portfolios. I think really the long-term view is, I think crypto is likely to be a part of every single sophisticated investor's portfolio, and really a separate asset class that kind of, right now it's still the weird thing to have exposure to crypto. Like it's still kind of have to, why are you doing risky things, and then why would you have crypto exposure? I think that's going to flip 180 degrees, where really it's going to be the weird and the outlandish thing to have zero crypto exposure. It's like people saying, oh no, I have zero tech exposure, and like I don't own a single stock in the Nasdaq. Like that's kind of a weird position now if you have a broad diversified portfolio. And I think a similar thing is going to happen to crypto, where it's just a normal part of every single investor's kind of portfolio construction.
Okay, good point. One more question, because you focused pretty much on the staking rewards, and for me, most people talking about staking rewards mention that there is a risk of this slashing or punishment for misconduct, and I personally have never really heard or encountered that this really comes up as a cost, and that there is some slashing taking place. Maybe I'm just not deep enough into it. So is this a risk of staking, that under certain conditions and even in cases of unwillful misconduct, your ether that has been given into a staking protocol is gone because your staking partner has made something wrong? How do you look at this?
No, I don't think that's a risk. Like you have to be like actively malicious and like actually like basically run fraudulent programs trying to kind of basically contradict what the truth of the chain is. The much bigger risk for stakers is probably uptime / kind of downtime being the risk, because you also do get slashed for, if you run a validator, you basically commit to having that be online at all times in case you're kind of selected to randomly forge a block. And so you get slashed for being offline. Basically you have to be online, and your validator has to be running at all times, and you get slashed for not having your validator be online. And that's probably the largest kind of technical risk you incur. If you use something like Lido, where you have tens of thousands of kind of validators running, where you kind of even out all of that risk, and like if someone is offline for a few minutes, it doesn't really matter. The impact isn't that great. I mean, we went and did the analysis. I think if you have uptime of 90%, your rewards are like 10% worse or something. Don't quote me on that, but it's really not that significant.
So for you, I mean, there are risks, of course, but the slashing risk is not a relevant factor you should explicitly deduct from the staking rewards by saying, okay, but the cost, there's a cost to it, and it needs to be estimated at 2% or whatever.
I think all of the reputable staking providers do a good job of preventing that, knowing that they get slashed for being offline. And so I think it's a small risk, but it's not super significant. And also kind of the extent to which you get slashed for kind of once in a while, not being live, aren't really that relevant in my opinion. And so I think it's quite a small risk.
All right. Always good to end a talk about investing in crypto with the conclusion that there's a small risk. Everybody is aware that there are lots of risks in principle, and this is pretty interesting alternative in a moment where there's the inflation at 8 to 11%. This appears to be the single one opportunity to make good for inflation with a financial instrument that's giving you carry or a yield. Let's see how the momentum in the market is going to develop, and of course let's really see and not speculate on what will be the impact of the merge on the price. So final question, how will it eventually, how will people realize that the merge has happened? And you see it because there's a new block, or is there a press release, or what exactly will be the process, and how will people like me and you and my mother get the information that it has taken place?
I mean, so it's expected. So the total kind of final difficulty has been set, and that implies a merge around September 15th, around noon in Europe, and so it should happen around then. Probably the best way to follow it is to be active on the Ethereum Foundation. Has a very good blog and a very good website where they kind of update people who are interested in what's going on. That's probably the best way to follow that in real time. And then Alloy is gonna we're putting out a very in-depth report on staking and what the yield is going to look like tomorrow. And so second best resource is us.
Okay, cool. Paul, this was a great pleasure having you here online today, and I learned a lot, and I do hope that our participants were able to get deeper insight at least, and I do hope that some others will look at the recorded part of it. Having said that, we will publish more information about our next physical events. We intend to do something here in Hamburg. We will do something together with the Hafengeburtstag, which will take place in September. We will have a special NFTs event quite soon. Please watch our website. Please register for our newsletter, look at our LinkedIn profile and all that. And yeah, thank you, Paul. Have a nice evening, and good luck. All the best with Alloy, which appears to be a quite interesting and promising project.
Perfect. Yeah, thank you so much for having me, and I look forward to the future events.
Cool. Okay, cheers.
Perfect. Have a good